donations from CEOs of mortgage companies. And that was just the beginning. So we've been raising money ever since, and he now has a huge research team at Johns Hopkins. He doesn't take patients, by the way, Ken Pienta. He takes guys that meet certain requirements that allow him to do his research. So I'm one of his guys. I'm a guinea pig. And I've had extraordinary treatments in Germany that have just stopped the cancer, as well as what's going on here. But Ken's leading the way for fighting all forms of cancer with this breakthrough discovery of this keystone cancer cell that they made a discovery. It's changed everybody's thinking around the globe. I'll give you an example. The head of the professor who holds the Einstein chair at Princeton, which is, was Einstein's job at Princeton when he was a professor and researcher there. It only goes to the most esteemed research experts in the world. He left Princeton and moved to Baltimore to work on this research for Johns Hopkins. So, the team's making incredible advances. It's one of a kind in this country. So I started a campaign called Stevens Strong, STEVENS STRONG. You could Google it right now, and my page will come up top of the list in Google. We're raising money to try to keep this research going. I want to tell one last story, John. I got a call. One of my clients is an independent mortgage banker, a fairly good sized company. One of their LOs in Michigan or somewhere reached out to me. His dad had advanced stage 4 metastatic prostate cancer. Guys may understand this if you're over 50. His PSA was 1,300. I mean, unheard of. And he called me and he said his dad can no longer walk, and this is the last chance. I hear there's something in Germany. Is there anything you could refer me to? So I referred him to the team in Germany, Professor Baum, who's doing this research out of a town near Frankfurt, Wiesbaden. And he got together with Baum. His cancer he's gone through 2 rounds, I guess maybe 3 rounds now with Baum on this incredible breakthrough discovery that's now just making its way into the US. And the loan officer emailed me on Father's Day and sent me this incredible bottle of bourbon. I can't believe the price tag on it, as a thank you. But he said, I played golf with my dad. We would have never considered that he'd be ever play golf. In fact, he'd probably be dead by now. And now it's come back. So the breakthroughs of cancer in this world, just when anybody gets cancer in your family, don't think the local hospital, no matter what the name tag on it, no matter how great the hospital is, can actually treat that form of cancer. Expertise is limited, and it's very varied in terms of treatment capabilities across this country. And so for my cancer in particular, and for what ultimately I think will help breast cancer in particular, once it's metastasized, is this team at Johns Hopkins. And that's what this money raising is going for. So
yeah, no, that's amazing. We'll definitely get Stephen Strong sent out to all the folks here on our call today, and to our members as well. I mean, that is an amazing story. I lost my mom to cancer several years ago, and so yeah, I mean, that just tugs at the heartstrings a little bit, man. But great to see you. So I'm going to do your bio here, in which David Stevens really should not need an introduction, but I'm going to go ahead and attempt to give him one anyway. And for some reason, if you have not heard of Dave, he's been a champion and I guess student of the mortgage industry too. He goes back to his days coming out of college and jumping into the mortgage industry as a loan rep. So he's sat in your chair and sat face to face with consumers trying to buy homes. Grew all the way into running an independent mortgage bank to becoming the FHA commissioner under the Obama administration, and then after that becoming the president of the Mortgage Bankers Association for several years. He's advocated, he's testified before Congress and on Capitol Hill more times than he has fingers and toes. It's been engaged in pretty much every aspect of the mortgage channel, and now Dave is semi-retired. I'll say semi-retired. Because he does still have a independent mortgage consulting firm, Clear Lake Consulting. So with that, David, welcome to the NAMB Ledge Conference. Obviously, with COVID, everything is still virtual, but it's got its pros and cons. And one of the pros is, we get to have you to ourselves here in a rather intimate setting. So I'll just kick this right off. We did build in a little extra time with all the late breaking news that came out from yesterday, from the Supreme Court decision and the Collins versus Yellen. Will you kind of share us your hot sports take on and break down what happened there? How will it impact Fannie and Freddie, our borrowers, our brokers, consumers, and go from there?
Yeah, sure. Thanks, John. And by the way, my company is called Mountain Lake Consulting,
Mountain
not
Lake.
Clear Lake. But anyway, Clear Lake's a California place, so I have been there. And whoever asked the question, even if I was on that short list, I wouldn't tell you. So so it's crazy. We've been waiting for the Collins case to come back from the Supreme Court. There were two cases. I'm not sure if you're both aware. They were both ruled on simultaneously. They were both heard separately, but on the same day, back in November of last year. One was a statutory case, and the statutory case was all about whether the conservatorship and what's called the net worth sweep in the preferred stock purchase agreement. You may remember early in the conservatorship, there was a third amendment to the preferred stock purchase agreement enacted that swept all the profits of the GSEs in exchange for them no longer having to pay a dividend on the $240 billion that had been advanced to them as capital, which at the time the GSEs were losing a lot of money quarter after quarter in the early phases. And I was in the administration, Secretary Geithner, Tim Geithner, I was on his housing team. And we were working on these things, but there was a concern that the GSEs were going to depreciate the cash reserve that had been set up for them, what's called the line of credit. And so they said, we're going to stop deteriorating the line of credit. We're going to write this amendment that says we're just going to take your profits, if there are any, in exchange for not having to pay dividends back to the taxpayer or not drawing from the line of credit. So all of this happened years ago. So that was one case. And that's an important one. The other case was a constitutional case, which was a question of whether a single director who can only be terminated for cause heading a regulator in the United States is constitutional. And they had ruled on that, a similar case, the Sealy case, which was challenged against the CFPB. And the Supreme Court ruled that it's not constitutional, and that's why Kathy Clevenger was out the day Joe Biden was sworn in. But Calabria's case hadn't been ruled upon. He could only be terminated for cause. We were getting there, frankly, I think, as a country. But I know the Biden regime was waiting and hoping that the case would ultimately be ruled on before they had to test the legal challenge of cause. So. Fortunately, even though it's a different Supreme Court than the last Supreme Court, there's different people on it, and the case is different. The role of the FHFA director made this a little tougher than the role of the CFPB director, but it was a unanimous ruling, no dissent from any of the justices, which is huge. And that's why Calabria is out as of yesterday afternoon, and Sandra Thompson is now the acting director while we wait for the president to announce who his nominee is going to be for the FHFA director. A couple quick points, John, is Sandra Thompson is a known entity to all of us inside the Beltway. I've known Sandra for way too long at this point. She was there in the previous regimes. She's really one of her key areas is affordable housing, so it's good to have her in there. I don't think she'll be very disruptive. I'm not sure she'll roll back anything quickly that you guys want to have rolled back, like the refi fee. We'll see what she does in her time there. I do think that the Biden regime will be announcing their nominee here fairly shortly. And we'll just have to see how that plays out. And I'm not going to give you any teasers as to who I think that might or might not be. But I do think that, the one thing that the Biden regime knows is if they're going to get an FHFA director through the Senate Banking Committee, which is where this starts to get a confirmed FHFA director, It can't be a radical. So it can't be it can't be Elizabeth Warren progressive. They'll never get through the banking committee, let alone a full Senate, because you can't lose a single vote. And so I expect it to be someone who the Republicans would like. One name being bantered about is a guy named Mark Zandi. He's the chief economist for Moody's Analytics. But Mark is a well-known, he's a very close friend, by the way, but Mark is also not only brilliant, he knows capital markets, and he was John McCain's chief economist when McCain ran for president. So he's a friendly in a relative sense on both sides of the aisle. So we'll see who it is, but thank God Calabria is out. That's the most important thing. So here's what's in play that I think you should see roll back. It's going to take time. So the thing you can roll back immediately is the 50 basis point adverse market fee. That's the refi fee that was implemented for absolutely no reason other than Calabria wanting to build capital for Fannie and Freddie. There's no risk associated with the refinance. In fact, any risk manager will tell you when you refi a loan on your books to a lower rate, you improve performance. And it lowers the expected default rate on it. So to call it an adverse market fee is complete crap. It's just it was part of Calabria's mission to shrink the footprint of Fannie and Freddie. And that's what he was in the process of doing. And I won't go into detail about it. There's an article on Housing Wire. If you all go to Housing Wire, it was published by me yesterday morning, calling for Calabria's head. I knew that the Supreme Court was about to rule. I didn't think it was going to be so quickly. I thought it was going to come today, frankly, because they usually put out the rulings on Thursdays. But anyway, I got it published, and 8 seconds later, we heard that the Supreme Court had ruled. But it was an article co-authored by myself and Bill Cosgrove, who runs Union Home out of Ohio. But that tells the fuller story as to how dangerous Mark Calabria was. And I've known Mark for 20 years or more, testified on panels with him in front of the House and the Senate. He's always the guy brought up to be the hardcore conservative libertarian. I'm either representing the NBA or HUD when I testify, but it's just really good he's done. So that can go immediately, doesn't require any act of God. Sandra could frankly do it right away. There are limits to what an acting director can do legally. Roy knows a lot of the ins and outs on this. You can also ping him to find out the legalese on what limitations an acting director has, but you can do a lot of things. The other things are part of this amendment that was introduced, that was agreed to on January 14th of this year. The amendment, the most recent amendment to the preferred stock purchase agreement. And in that amendment were several dangerous elements, one of which is your favorite of the day, 2-to-4s and second homes. And that's why you're seeing these amazing hits on pricing on those things. And what the amendment says is that you can't sell more than 7% of total volume as second homes or 2-to-4s in any rolling 12-month period. Well, the problem is you can't manage to percentage in our business, because last year when we're rolling in refis and we're overwhelmed with refi volume, even if you're doing the same second home and 2-to-4 business that you're doing today, it would have been just a minuscule percentage because you had so much single family owner occupied refi flowing into GSE mortgage-backed securities. Well, today with refis slowing and are going to slow even much more dramatically as we look ahead, that percentage of 2-to-4s and second homes, even if it was the exact same fixed dollar amount from last year, is going to be a lot higher. So to tell you where we're at right now, the market's producing about 16% of total volume today in mortgage originations in the 2-to-4 second home category. And obviously well above the 7% limit and much farther above than the 4% limits or whatever else. The GSEs are not clamping down on certain institutions. I talked to the broker dealer of the head of the broker dealer desk of one of the big mega banks in New York, who buys a lot of loans. They're right now are at 3% year to date, second homes and 2-to-4s, and Fannie told them no more. So, it's the 7% is going to be overmanaged because it's middle of the year, very difficult to manage to a percentage as I just described. So that's why you see the GSEs sort of saying, well, maybe we should put it at 4 or whatever to give us some cushion so we don't violate a contractual document. The PSPA is a contract. It's a legal document by which you can be sued for violating. And that includes the executives of Fannie and Freddie. So to get that changed requires an amendment change. So the new director will have to negotiate with Janet Yellen's office, and then each GSE and their respective boards of directors are going to have to approve any new amendments to the document, which makes us just a little bit longer in terms of process. And one thing, last thing I'll tell you guys, just because Calabria is gone doesn't mean we're done with our problems of a conservative director who wanted to shrink Fannie and Freddie. He was able to manipulate the boards of directors of both these companies. So Fannie Mae, their chair of the board right now is Sheila Barr. Sheila is the former head of the FDIC. She's a big Calabria supporter. I talk to Sheila at least once every 6 months. We just have a conversation about what's going on. She gives me her views, but she believes exactly what Mark does. She believes they should be on federal pay scale, all the employees. She believes the new capital rule that's going into place is good. It's terrible, guys. Terrible for all of us. It's going to increase G fees. But they're doing more. I don't know if you're aware, they're rolling out, they are in the process of implementing, now hopefully it'll get pulled back, an LLPA hit for third-party originations that come from correspondent lenders. So TPO, which is wholesale and correspondent, is going to get an LLPA hit. And that's in the process of being rolled out. It may not be public yet, but I have this from a very confident source that's being put into place. That violates part of the PSPA amendment from January, because the amendment in January said one of the things that's in there that was good is you can't vary pricing for any company or business model based on volume. It can only be done based on the credit characteristics of the loan. So to add a hit to third-party originations, I believe violates at minimum the intent of the agreement and could be subject to a court challenge. But all this stuff is happening right now, and so we're going to have an entirely different philosophy coming into the FHFA, rolling back as much of this stuff as they can, and then I just think the GSEs will then go back to the kind of support for the market that they've been providing the last 10 years while in conservatorship, without having a guy like Calabria trying to rip them apart. So that's where we are in the GSEs in a nutshell.
Well, that's great, and that's kind of a great little transition point, because one of the things that I was telling before you got on, I kind of reiterated the whole, hey, if you're not at the table, then you're on the menu, and
right.
And just kind of a hot sports take here too. It's unfortunate the way I see a lot of our representatives, elected representatives today, legislating via Twitter. And sound bites. And, I feel, me personally, that a lot of our representatives just jumped onto the Calabria bandwagon, if you will, without even understanding housing finance and really what goes on behind the scenes. And so,
yeah, I mean, John, to that point, for everybody to be aware, like Mark's a PhD economist.
Oh yeah.
He's never run a business in his life. He spent his entire career inside the Beltway. He worked on the Senate Banking Committee for Senator Shelby. He's a Republican. He was a very important member of that committee staff, basically ran the staff when they were in the majority. And then he went to the Cato Institute as a think tank, pontificator. And then they put him in charge to be basically the CEO, which is why all the CEOs of the GSEs quit, because they wouldn't work for him. To be the CEO of the two largest financial institutions on the face of the earth. I mean, unbelievable how that happened.
Well, it's unbelievable how that happened, and then it's even more unbelievable that our congressmen don't even understand what's going on and just follow Twitter. And so where I was going to go with that was, and I've got a few other hot topics here, but how important do you think it would be? Okay, so that's kind of working, between FHFA and Treasury. But how important do you think it is for our members to be, talking to their members of Congress or their staffers today and giving their take on and educating them on, this is how housing finance works. This is what a mortgage broker does. This is what a loan originator does. you know where I'm going with that, right?
Yeah. God, let me say one great story.
I mean, it's a lot.
So I was on the Hill after the Tea Party came in. That was 2011. And I was visiting a new member of Congress from Westchester County. She was a dentist by trade. And this was when they were hell bent on just wiping out Fannie and Freddie altogether. And Scott Garrett, Roy knows all these folks. John, you remember him too.
Yeah. Oh yeah.
But Congressman Garrett wanted to wipe out the GSEs and come up with, anyway, all this stuff was going on, just destroy Fannie and Freddie. So I was making the rounds, and I went in and met this member of Congress, very bright and energetic and part of this Tea Party movement, well-educated, the whole nine yards. She starts lecture. I walk in literally for 20 minutes. She lectures me on why Fannie and Freddie are crushing America's economy, and it's it's a huge risk to taxpayers, and just all the talking points that came out of that playbook. Finally, she stops for air, and our meeting's almost over. I haven't said a word. I never got to even speak. And I said, Congresswoman, it's been great to meet you. Congratulations on the new job. Can I just leave you with one thought? She said, yeah. I said, if I had a tooth problem, I would never go ask a mortgage banker how to fix it. And that was it. And I walked out. And I never saw her again. And she got voted out of office at the next election. But the idiots, we have a lot of, to get into these roles in Congress, particularly in the House of Representatives, you often get folks who are very uneducated. They rose up through the ranks. They don't have deep backgrounds, literally in anything, not even necessarily business. They're ideologues, and because of gerrymandering, they can get elected just by having an extreme view on either side. And for those that hate our member of Congress from, I guess she's from Brooklyn, AOC, or those who hate Matt Gaetz. I don't take your pick. I don't care what side you're on.
Right.
It's a lot to do with gerrymandering, and they now have a stump to make points. The problem is, it makes it really difficult to legislate because they don't spend the time to deep dive into things. That's why generally when we're trying to work on legislation hopes, we just hope we have the right majority on the House side, depending on the issue. And then you really have to work on the Senate, because the Senate has the folks who are longer term. They tend to have deeper backgrounds. They tend to be more sustainable in their jobs. So that's why if you look at the folks on the Senate Banking Committee, for example, even though we're going to have some turnover in the next couple of years, those guys have been around that committee for a long time, whether it's Crapo on the right or Warner on the left. They're also not real extremists. They don't tend to be filled with them. You have Maxine, who's about the most extreme, not Maxine, Elizabeth, who's about the most extreme on the Senate Banking Committee. So you can get stuff done that way, but it is really important. And it is important to go explain how the industry works. In fact, I have a deck that I use. I'm using it in Zoom calls for a client that explains how down payment assistance works. And all I do is, it's literally a deck that walks them through how DPA works, and staff will say, why are you showing this to me? Just so you understand it, so when the issue comes forward, you'll really understand the ins and outs of how these programs work. But it's a challenge. You guys being involved is really important. And I know Roy's said it forever. John, I know you have as well, even when you were helping the MBA. This is a world where members of Congress listen to who calls on them. And when you're NAMB, they don't know if you're 1 million members or 100 members. I'm sad there's only 53 people on this call, roughly, at least it looks like on the participant list. But you are all like hugely influential voices, and spreading the word, even getting your coworkers just to come and understand what the hell's going on in DC and what do we need to be worried about is really important. And an easy way to do this, because you don't have to be a member of the Mortgage Bankers Association, but tons of brokers are involved in this thing, is the Mortgage Action Alliance, because that'll at least inform you for free of the issues that they're worried about. And you'll get an email saying, hey, this is about to be voted on. It's a call to action. And if it's something that's important to you as a broker, you can push the button. And if it's something that you're not interested in, you just avoid it. Just hit delete. It's one great option. I know the NAMB does calls to action as well, but being involved is key.
So one thing I wanted to delve into just a second. So how do we discuss when we do get the question about the GSEs and the changes that are coming? You know, how do we make sure that how do we answer like, hey, another mortgage meltdown 2.0 is coming, because it's basically gonna go back to anybody that wants a house can get a house. How do we, you know, I know we have a lot of rules in place right now, but a lot of those rules may be loosening up. So that's why we get a little worried about. We don't want to go through 08 and 9 again.
Yeah. So look, guys, anybody who tries to compare the current market to 08 and 09 has been smoking too much legal weed in their home state. Let's talk about the differences. God, I was going to pull up a slide, but I just don't want to take the time to search for the right one. But while we're doing this, I'll just see if I can find it. But the demographics in 2008 were entirely different than they are today, and that had a lot to do with why the housing market failed. That and unsustainable mortgage products. Oh, I didn't want to be a diversion here. So let's go through the two basics. One is in the period leading up to 2008, really started in the early 2000s. 2003 was the biggest mortgage origination year next to last year, almost neck and neck. 2005 was the biggest purchase year in this nation's history, next to what's going to happen in this potentially this year. But both, there were two things happening. We had very unsustainable credit. Anybody who was in the business back then, you remember, a lot of people are new to this business post 2007. We have a ton of new originators, but if you were in the business beforehand, you know, you could get fog the mirror loan from Countrywide. 100% LTV, 20% piggyback on an 80% NAMB coffee arm. That's what they sold. And that was not uncommon. Subprime, stated income, CISA, NINA, et cetera, were everywhere. And that's what led to everything you've seen. If you haven't seen the movie The Big Short or go back and watch it again. That was in there. All of that's outlawed. It's not, these aren't rules that can be changed. They're outlawed explicitly in Dodd-Frank, the legislation. You have to pass a bill to be able to introduce these loans. You can't do NAGAM anymore. Can't do CISA, can't do NINA, everything you have to prove ability to repay. Now we'll talk about that within QM standards in a minute, but all of that is permanently done. You can't have extended term loans under the Dodd-Frank legislation. Yes, there's stuff that was done by rulemaking on top of that. The QM rule, what constitutes a qualified mortgage from an underwriting standpoint outside of the outlawed products, that is rulemaking, but someone would have to come in and do new rulemaking and change that standard in such a way to bring us back to that period, which just frankly is not going to happen. So today, the credit quality we're originating is the safest and soundest, frankly, than I've ever seen in my, I originated loans in the early 80s. I've been doing this way too damn long, and we're doing the best loans that this nation has ever done in terms of mortgage origination in total. There are some fringe products out there. I know you get them on your fax machines and through email, if we even have fax machines anymore. But there are guys baiting the market with bait rates and alternative doc loans through the non-QM bucket that allows you to show 6 months of bank statements. All that stuff's going on. Marginal, so marginal. The 98% part of the market is all full doc, and you guys know this based on the loans you're doing. So that's one change. The other change is back in the Great Recession, we were losing in household formation. We were losing owner-occupied homes at the rate of owned homes at the rate of 600,000 homes per year, so almost 6 years in a row. Why? Because it was Generation X that had reached their peak buying years. Gen X was then in their early 30s. The peak buying year in America is age 34 right now. So we had a smaller generation following the baby boomers, and so we had a slump in demand and terrible credits that had created a massive bubble with too many people owning too many properties that never should have been sold in the first place. Take it fast forward. We have an incredible, God, I gotta find the slide for you. You'll kill me if I do this, right?
No, take your time. We have Congressman Perlmutter coming up in about 20 minutes. So you got plenty time.
Okay, so bear with me. Don't look at the front page of this deck I'm gonna pull up, okay? But I just wanna show it to you. Are you able to see me right now?
Yes.
See my screen?
Yep.
I just want to take, this is for George Mason that I did recently, but I just want to scan through real quick, excuse me, to one slide. And this is this slide. So just bear with me, guys. Look at this slide, okay? This is the entire United States population, according to the 2020 census by age. All right, that's where we look exactly right now, or at least last year, according to the 2020 census by age. Look at age, the line I have at age 34. That's the peak buying year for first-time home buyers in the United States, okay? Coming behind us right now are bars that are either equal to that or higher than that for the next decade, approximately. So this demand is not only not going away, it's only going up for a decade, guys. The reason why the Great Recession was compounded by bad credit is take the 34, 35 age, now go out to 44, 45. That was a decade ago. That's that dip. And that dip was, that's right here. And that dip was the Generation Xers. It was just too small a generation. We were losing owner-occupied households at a significant rate. It's just an entirely different environment for home buying. I go out to realtors and home builders. I'm doing like huge realtor audiences. Brian Buffini, many of you guys know who he is. He had me do a presentation. It's now been seen by over 125,000 real estate agents. I showed some of this data to get past the emotion of the world's going to blow up. Data really matters. And I got a lot more slides to cover the data point, but I did a presentation for one Compass office in Northwest DC. The head of marketing for Compass nationally happened to be attending that meeting. And next thing you know, they're asking me to do the whole country. You guys, if you can get good data, and I could do this in another presentation for you if you ever want to do it, but you know, we have an incredible market ahead of us. This is going to be the biggest boom in housing demand that we've seen since the baby boom generation started buying homes in the 1980s. It's the biggest generation in history, and it's just rolling into their peak home buying year for their first time home. And that's why you're seeing this crazy demand going on. It'll slow a little bit. They're going to be equity takers coming out of this pandemic who want to get the equity out of their homes. They'll put more homes on the market. And we're going to see home price appreciation go down, thank God, because it was 13% year over year, April to April, according to CoreLogic. And so, you know, we're going to get down to single digit home price appreciation, but it ain't going negative. There's just nothing here possible to make this market go south, other than a big, rapid economic collapse hitting us due to some external event that we're not aware of right now.
Right. So Roy, there's your answer when Congress asks you, says that, well, make sure you were not blowing up the economy again. It's like, well, you got
that one slide alone is awesome. That was done by Mike Frattantoni, the chief economist at the MBA, but he just pulled it from you know, the census data. I mean, it's crazy.
So that chart plus the dearth of building new homes and multifamily is basically what you're saying is like, this is going to just, the demand is just going to keep going up. Is that what I'm seeing out of that chart?
Yeah, demand's going to keep going up. We are going to see a growth in home sales. Let me see if this is the one. Oh, that's commodity prices. Hold on. Sorry. Let me just show one more. I'm getting close here, though. It's getting a little bit easier. So this is single family housing starts and builder confidence. So the HMI is the builder confidence index and single family starts is the blue line. We'll look back to 2013. So even though the cost of building homes has gone up and there's now this $30,000 package cost on home building, the units, single family home starts are still at a level right now we haven't seen since about 2004. So, you know, the good news is we still have to build a hell of a lot of new homes. We have a huge shortage of them. They can't build them fast enough. I'm doing a big thing for a bunch of home builders tomorrow. And they want me to talk about the dearth. They can't get people to come hammer nails. I mean, they're literally freaking out because they can't get people to come build homes for them. The same as the airlines, same issue. But that'll resolve itself. It's like Powell said, Chairman Powell of the Fed said in his testimony this week when asked about this employment gap. He said the employment problem is only in industries that are having a surge out of the pandemic into recovery. So we're all flying. I've already taken 2 trips since I was able to take off my mask, except on the airline. But I hadn't flown for a year and a half. And all of us are taking trips. We're all jumping on airplanes and all that. So shortage of people, they just can't. You can't turn it on in a second like that. It's going to resolve itself. We're going to get back to kind of normal employment levels, and we're going to hire everybody. Same with the home builder industry, but that's going to resolve itself. If I have another slide up there, I want to show you lumber futures. Lumber futures going out into next year are half of where they are today, because Canada is now allowing their citizens to go back to work. They had a harder clampdown than we did in the U.S., and all our lumber is coming from there, so they couldn't cut logs. And on top of it, we had a tariff problem. So, this is all going to resolve itself. It's a problem right now that's causing extraordinary appreciation and a shortage of inventory and multiple contract offers, all that other stuff you're dealing with. So if your buyers are smart enough and they go in with the right offer and are able to, and are willing to take even a hit to go slightly over, they're going to get paid off, because the home price appreciation is going to continue regardless, and then they're going to get near historic low rates. If someone's thinking of selling and they're delaying their decision to sell, they're crazy, because more people are going to come to market as we open up the country. They're going to be more comfortable going out to shop for homes, so more comfortable listing. If they list now, they're likely to get a better price than they will later in the year. I mean, there's all sorts of great discussions you can have with real estate agents, even if you've never known them before, to start rebuilding your base after what's been a killer, couple of years of refinances.
Yeah, no, it's great. I got a great anecdote to that. When I talk to our broker partners out there, for the loan officers that I speak with, for every one deal that they actually get contracted up, they have another 20 pre-qualified buyers that are just still out there shopping. Yeah. So the demand is definitely there, and it's not going anywhere. Along those lines, I kind of want to pivot a little bit, because I think this is going to be a big deal for the industry in the next year. The Bureau has been fairly quiet in terms of examination and enforcement activity in the last few months. I think while they're getting their sea legs back, right? And obviously we're it's now coming. It's now a talking point, which is probably a good thing to have the conversation out there. But I think the disparity in housing demographically. The stat that I always used to throw out all the time was when I was doing the speaking circuit, was the 2010 data of household net wealth broken down by race. And for white families, it was 114,000. For Asian Americans, it was 69,000. For Hispanics, it was 74.55, and for African Americans, it was 49.80. And that was based off the 2010 data. So yeah. when that 2020 census data finally comes out to the bubble, it's going to be worse. So do you think that, or what do you feel we're going to get from the Bureau as far as the administration really pushing out on how do we get housing or get minorities back into the housing market? The Wall Street Journal yesterday had a deal that said that like 12% of white borrowers were able to refi last year, but only 6% of Black families did. So yeah. There's definitely disparities there.
Well, look at this for one example. So this is another project I'm working on related to this. But first of all, the quick answer is watch out, guys. This is one slide that's the Public Economic Policy Institute, but it's an interesting one, because if you look on the left side, it's just what's the median family wealth by race, Black versus white. 183 for whites, 33 for Blacks. And this is 2015 data, all right, John? So slightly newer. And then you look at families who get an inheritance. So what happens after you get an inheritance from your parents? The white impact is enormous, right? Because they had wealth to begin with to leave on average. So the average wealth goes to 287, very little change for Blacks. And so why is that? It's because, we as a society haven't created wealth opportunity to build wealth through home ownership for minorities. And there's a lot more to this story, but it's a big deal inside the administration right now, and particularly in the White House. Oh crap, I had a much better slide on that. Give me 1 second. Here it is. And so this gives you an example. Home ownership is right now the #1 driver of wealth in America. And I want you just to look at, this is the most important slide. So look at the composition of wealth. This is Edward Wolf. I don't know, it's a great source for data, but it's a survey of consumer finances from 2017. But look at middle income Americans on the left and look at where their wealth is stratified. Their #1 form of wealth is a principal residence. That's the purple area. 62% of total wealth comes from the principal residence, which you only get if you own the dang home, right?
Right.
People keep talking about the stock market and how great the Dow's doing. Well, look at the ultra rich, the net worth of 10.3 million or more. Yeah, they're doing great in the stock market. Even upper income does well in the stock market. 18% of their assets are in stocks. But entry level homeowners aren't in the market, man. They build their wealth through home ownership. So if you don't create home ownership opportunities for minorities, we are going to have a very difficult economic challenge over the decade ahead, because 2/3 of all new households being formed are going to be minority. NAREP put out in their annual report that Latinos are going to control 60% of all homes sold over the 15 years ahead. And so, we have a real challenge here as an industry because we're still mostly white. We have much more diversity today than we did 10 years ago, thank God. But es muy importante para puedo hablar español. Sí, puedo hablar un poquito.
Si hablamos hipotecos.
Sí, and but these are things that are really important for long-term economic strength of the economy. And so the Bureau has one big thing going right now, is appraisal discrimination. That's going to be a big deal, and so does HUD, with Marcia Fudge leading an interagency effort to look at appraisal discrimination. So what should you guys do about it? Anytime you get an appraisal back and it's a minority borrower, if it's either a counter or a decline, even if it's an acceptable counter, I would do a second level review. I would at least talk to my investor, whoever you're selling the loan to, and recommend they do a second level review. I'd even have a letter in the file that you keep permanently saying you recommended a second level review, because appraisal discrimination is real. I wrote an article about it just recently on the subject, pulling data from around the country of where some appraisers have bias, and it's a human business. And so that's one example that you're going to be looked at. I also want to emphasize to you that the FHFA is right now hiring 3 people to look at non-bank counterparty risk. And so that's an area that we have to worry about, particularly for independent mortgage bankers and brokers who are selling into the market. So because any loan you originate gets what's called a TPO code in the securitization process and the servicing system. So you're getting a third-party originated code on any loan you've created as a broker. So it's relatively, it's not completely easy, but it's easier to track back. So, I just say, be astute as we think forward in the business. And I know we're running out of time.
Yeah. But Dave, on the appraisal, NAMB did see that a couple of months ago. We did send out a sort of like survey, because we wanted to gather data, because in Washington, you can't just go up to the Hill and complain. You got to show me some data. So
yeah,
we did, and we maybe we'll send it out again. But we sort of had one of we couldn't really interpret it well, and a lot of people maybe misinterpreted. But a lot of people were confused as how actually does an appraiser, is it just ingrained bias, or is it just how does the discrimination occur? Because they're looking at raw numbers.
They go into a home and they see pictures. This whitewashing of homes is a real deal. I don't want to get into start and touch emotional buttons for some, but I'll give you one personal example. A guy who's Harvard graduate, MBA from the Harvard Business School. He's a very senior guy in a great company. I can't go further than that. I've known him for 15 years now, I guess. He and his wife, they live in DC. Beautiful neighborhood, Roy, up in Northwest. Beautiful home. They bought their home. Obviously, rates went down. They wanted to refi into the twos. They get a home appraisal. Appraiser comes in, appraises the home at $124,000 below what they paid for it. While their home's literally across the street, down the block. He showed me the comps that didn't appraise that low. So he escalates it up. The bank that was ultimately going to buy the loan ordered a new appraisal after a lot of complaints. He whitewashed the home. They took out all the pictures of their Black family and their kids, and they had their neighbor, who's a white person, come and greet the appraiser. Appraisal came in $74,000 overvalued. So, and those stories are not just isolated, they're all over the country.
Yeah.
Sometimes, folks assume that, especially if they're not from DC, they may assume that's a minority neighborhood. And then minority neighborhoods, we know, appraise lower. You go into Prince George's County in the Beltway versus Montgomery County, same home, same square footage, you're going to get a different value. Now, there's reasons for that. Data supports some of that, but there's a very strong perception going all the way to the president that this is a real deal. So I just think we all ought to keep an open mind. Let's hear the information, hear the data that's being presented. I did enough research on my article that's in Housing Wire. You can search it. If you go into Housing Wire, pull up my name. They have all my articles in one area. Just read my article and look at all the reference points I had. I think a couple of cases you can say it's an isolated incident when you have as many as I've been able to get so easily. I don't know. And whitewashing is now a common word used. The Association of African American Appraisers in the United States recently published an op-ed in, I forgot which New York paper, that appraisal discrimination is all over the place and how they advise their clients to whitewash their houses before the appraiser comes in. So
That's awesome.
It's just going to be, whether it's true or not, guys, it's the perception at minimum that this is a real deal.
And that's reality. Perception is reality. So
yeah.
Regulatorily, that's going to be, it's going to be knocking on our
Yeah,
door.
and by the way, I want to shout out Kimber, who I see his face over here. So, hey, can I make two last points, Roy?
Yes, please do. Please.
I wanted some free lobbying help, so I'll leave that at the end. I want,
Yeah. So two things. One is, I've gone back and forth with UWM on their behavior in the marketplace, and I think competition is great, and I think UWM has done a great job as a company filling needs for mortgage brokers. That's all good. I mean, that's what a good wholesaler should do. When the first wholesale lending came out and this AIM stuff started happening, I called out, what's his name? The former head of AIM.
Yeah.
I can't remember.
And
I even did a long, I don't know if it was a Zoom call or podcast thing with him, just talking about, behaviors, man. We're a professional industry. It creates a dirty look for our industry when you have a CEO of a public company wanting to, going on earnings calls with his shareholders, talking about how he's going to kick that crap out of so-and-so, or I'm going to ban, you if you do loans with my competitor. It makes the mortgage industry look like we might as well have striped shirts and striped, coats on and white plastic shoes on, or whatever the view of the old traditional used car salesman is. It's a really bad look. And so what was his recent one that he came out with? His price war that he announced against a list of competitors, which, by the way, I've been in this business a long time. You never win a price war. But anyway, I was on a call and I said, these are desperate acts. I think it's an act of a company that probably had 70 or 80% refinance mix last year, just went public, and he has to prove to his shareholders that he can do well. And I get that, but we don't attack I just don't believe you ever attack the competition. It's not the way to behave as a professional. And it certainly sets a bad reputation with other policy leaders inside the Beltway, having been ahead of a regulatory organization. But after I made the comment about the 7% price war the other day that he was announcing with that list, he somehow heard I had said something. My cell phone rings. There he is, and Matt wants to, yell at me and tell me I'm whatever dirty word he could come up with, and I wasn't going to take the bait like others have. from Quicken or elsewhere. That's, great, Matt. Have a great day. But it is, it's a good company that had good technology, but they're trying to play this game differently. You guys have, if you're a long-term vision career player for your business as a broker company, you just don't burn bridges with any investor. I saw Countrywide fail overnight, and they were the biggest buyer for brokers for many, many years. And they went down overnight. Imagine if that happens to any of these companies out there that play hardball this way. And so, with all due, I'd give Matt all due respect, but unless he's absolutely like the must-have, I'd say I'd love to do business with you, but I can't burn bridges with my other investors who are also providing a source to our business. I'm a broker. And my value proposition is that I offer my clients the best choices from a multitude of lenders across the country, of which you've been one. And I thank you for that. But I think it's just they're putting you guys all in a hard place, and it's unfortunate. And hopefully that changes over time.
Well, I think it'd also be tough to explain to a regulator why you're 100% of your business is going one place and you're 1099.
Yeah.
So,
hey, by the way, when Perlmutter comes on, my wife and I first met on a Senate campaign in Colorado back in 1984. Carlos Lucero and Perlmutter was also involved in that campaign as a volunteer, where we were all young people back then. So my wife actually worked on the campaign.
Wow.
So he was a Democrat running for Senate. Well, you guys look.
What we do, one last, I was just going to say, we've been pounding on, not maybe this isn't the right spot, but brokers have been given a tough hand here with this 3% cap on compensation. And as much as I go up to CFPB or the Hill, no one is, it's sort of like, and actually it's theoretically, it's really 2 3/4 for most people. So, we keep pounding our, going to the Hill, we go to the CFPB, go to the Hill. The NBA has been very good. They sent a letter in support of, our bill that would correct that a little bit. But we're just, is it one of those situations where no one, why is it that, no one wants to, they understand it. They understand it hurts, in some price points in the mortgage business, but you can't really get, whether it's a Trump CFPB or maybe or an Obama one, it's just hard.
I don't think it matters. I don't think the president, the party in office is going to matter on this particular rule. I mean, the yellow comp rule is highly dysfunctional, right? Both for brokers and independent mortgage bankers versus bank LOs, because you have to disclose things differently. And I've argued all along that, my biggest argument against it is not the unfair aspect in terms of how companies ultimately can pay their loan officers. I think it's unfair to the consumer, because the consumer's seen different pictures about how the points and fees add up, and you should be able to show total compensation. And then if it's an in-house title company, it has to be added in part of it does or doesn't. I mean, the whole thing's ludicrous. We should have all the fees. If you really want to disclose it to a consumer, be totally transparent, and then the caps will be the same for everybody ultimately. Yeah, it's a problem. And this part of the rule, this part of the yellow comp rule caps, I think, non-bank originators generally across the board in a different way than it does others. But I don't think, Roy, you're going to get a law passed, and you know that too. And a rule change is probably your best and brightest hope, but you'd really need great support. You need all the AIM guys to come together with you and have all brokers together en masse go in on this thing and make it a priority. And you've got to put some money behind it. One thing that, as you know, running NAMB, I hate to say it, guys, the brokers don't really financially support. You guys do because you're all here, but brokers don't financially support the trade association enough to become a stronger voice as it could be. And you got to have money to move stuff around DC. So anyway,
I appreciate that.
That's the way it works.
Yeah.
Thanks.
All righty. Well, I appreciate everything, and I'll turn it back to John or Kimber.
Yeah, I was just gonna say, Dave, thank you again so much for joining us. It's always great to see you. And hey, shoot, before we know it, we will be seeing each other at live events again. So
Well, I'm speaking at the New England Mortgage Bankers Association event. If any of you guys go to
All
that,
right.
look for me there. Yeah.
well, there you go. Dave, thank you
That
so
would be
much.
my first
man.
one. All right, guys. See you
Thanks,
later. Have a
Dave.
great one. Yeah. Hey, see you.
So
Kimber.
John,
Take
what
care,
we'll
Dan.
do is we'll get